Happy Friday, everybody. Welcome back. Another episode of Real Assets Weekly. This is the ninth episode. Today is June 30th, 2023. We're coming up on the end of Q2. And what a first half of the year it's been. Jimmy, how are you, my man?
I'm doing great. Happy Friday, Turtle. We got the month end markup, the quarter end markup. It's been a very wild market. This is definitely one of those moments of you think back 6 months ago of things that should happen and things that do happen, right? Just Mr. Market humbles everybody, bulls, bears, macro hawks, what have you. But here we are. We're getting ready for the second half, and I hope you have a great July 4th weekend. Don't blow off any fingers, man. And if you're gonna barbecue, maybe some disability insurance too, ahead of the fact.
I love it. I love it. Yeah. Yeah. I mean, look at these are weekly bars. If you just look where 2023 starts, I mean, everyone probably that's watching this show is exactly familiar with kind of what's going on out there, but just relentless bid to start off the year. And it's no one's really that, it's like that's what I think is interesting right now about real asset stocks, right? Whatever which it's kind of a broad term, but that's what's interesting about real asset stocks is they're kind of forgotten about. A lot of these sectors are still negative year to date. I think it's 4 or 5 sectors are still negative on a year to date basis coming into this week. And, they're not associated with AI. And they're kind of left for dead. And if we look at the, something like maybe like the value to growth ratio is also kind of interesting to look at. If you look at 2023, it looks like QQQ, right? It's just a relentless chase into growth assets at the expense, or at least at the relative expense of value or real estate stocks or energy stocks, which were all the rage in 2022. Let's look at here one last chart here. If you look at REITs versus SPY, it's even if you just look at REITs versus SPY, it's just relentless. That's the point. And again, everyone kind of gets this at this point, but
you talk about some of the index constituents that are really driving a lot of this performance. That S&P 7, that magnificent 7, whatever you call it.
Yeah.
But it's funny how it lines up so well with the technicals. That NASDAQ right at 370. Full disclosure, I added more to my SQQQ position right around here. So where I stand. Would I be surprised if we went down 20% and retested 300? Probably not. I don't. Again, it's the price drives the narrative. You're at some point you got to take a bet again with against what's happening or thinking about what's happening, and we're about 10% away from all-time highs, which is crazy to believe.
Right.
But that's for a later segment, I suppose.
Yeah. And no, I mean, I think that's what's tricky. One last kind of thing on the macro, and then let's jump into some REIT stuff. But it's like, so to your point, it's like, we're 10% from all-time highs. It's pretty wild. However, we are still below where we were at the end of 2021. And in so many ways, it's really been hard to make money since the end of Q1 of 2021. And I think, that's something we keep going back to, but that's maybe why, I don't work at a pod shop, you don't work at a pod shop, but it's like, but as far as, we are cross asset class investors, right? Like I'm not just trading Qs, I have Forex pairs on, I've got some bonds, unfortunately. Aside from NASDAQ stocks, it's still been difficult out there to make money. In the Forex market, right, is the dollar's been strong, right? So I guess the point is just that it's been really difficult to make money since Q1 of 2023. And that's maybe why, and the one, it's like they've slaughtered a lot of sacred cows in the last several years. And the idea, so if you don't think that you're your NASDAQ could be slaughtered. I think that you're, naive, but also look, it doesn't mean it can't, it absolutely can keep going higher. And in fact, at this point, it's, why wouldn't it? It's like almost so many days, the chart pattern is the same, right? It's like,
Yeah, I mean, I think it's bullish trade, certainly, maybe bullish trend.
yeah,
Again, I think there's a lot of volatility suppression,
yeah,
particularly around the June 15th or June 16th OPEX, quarter end, a lot of different flow dynamics that we don't really have to get into. And
right,
it's also not a cop out, because the performance is the performance, right? And we're trying to explain why things are happening the way they are, and how you have these 2-3% aftermarket reversals, and
right.
it can't puke at the open and it comes right back. There's a lot of things going on. I think in you and I as well, working with our clients, looking at some of these hedged strategies that have become very popular. You imagine if you were in a hedged strategy and we've had this vicious bounce right after year end, right? We had a lot of tax loss harvesting. You had some capitulation in December, but year to date, especially S&P and NASDAQ, people are up. People
Yeah,
who kind of stay the course are up. And if you're fearful about the market, everyone is trying to get downside protection.
yeah,
Everyone is happy with 5% on the up, and they want to protect against 15% on the down. And so there's a ton, just again, behind the scenes, the market makers, the hedging activity. It's a consensus hedge, right, to buy protection right now.
right.
You got a couple people talking about all-time highs, but most people are still clawing back from 2022.
Right,
And
right.
there is a fear, and that's probably what keeps the market, kind of buoyant right now.
Yeah, yeah, climbing that wall of worry. And
Yep.
yeah, exactly. And you get these people that are like, oh, there's these bears out there, and they're like, there's, Twitter has become such an echo chamber of just people yelling about stuff. But it's, it's like there's, again, back to that. Well, everyone kind of knows though that like there is this, there is this we've all just seen how Bitcoin was the next big thing, and then boom, then it's down to 20K. Now it's back to 30. Now it's struggling to get, now it's kind of popping back below. So point just being that you're right. It's like we're just climbing this wall of worry. Yeah, I don't know, man. But however, that's okay. I mean, that's okay. It's not a, it's not, I think it's silly to be bullish or bearish on stocks. Just walk in like, I'm a bull, I'm a bear. Okay, great. It's extremely one-dimensional. And yeah, heck. But with that said, look, you've probably been successful if you've just been bullish all year and you just kind of chase momentum. That's great. At some point that it doesn't, at some point, like everything, it'll have its, you'll have its give back. Enough macro maybe for one episode. Jimmy is very much a domain expert in something we want to talk about today, which is real estate investment trusts. Jimmy has a Wall Street background, worked on the buy side, worked at a shop that did REITs, that invested in REITs exclusively, so he knows them very well. So what I thought would be interesting to talk about with Jimmy is last week we had Pescadero Energy, Ryan Cobb. He's a landman, and he's also he's also an investment guy like us, and he was talking to us about specifically BSM. And what's interesting about BSM, actually, another financial research outlet called Grizzle does a great job. They had a piece on big boats that can get us through this very choppy natural gas bear market, right? This very choppy water, right? And BSM is a great example because they don't have debt. They're a royalty company. So they're almost uniquely structured to be a big boat that gets you across this very stormy ocean. If, let's say, for example, you're thinking about natural gas, and you're saying that natural gas is secularly bullish, but we've clearly been in a bear market now for about the past year. So back to REITs, right? Another form of real asset. Are there boats that we can simply hang out in during this? Let's look at XLRE here, right? If things are so rosy out there, what's going on in real estate? Eric Basmagian, real estate is the economy. Now, real estate is holding up okay, and that's what we talked about with David Arback 2 weeks ago. But real estate investment trusts are sick. They're the canary has been dying now week after week after week. And so what we want to talk to Jimmy about is just how can we think about places to hide out in office or just real estate in general that could allow us to get to the other side and take advantage of potentially this bear market. So that's a lot, but maybe start with you. How do you think about that? And to tee you up a little bit, you had mentioned to me before, like, look, REITs are different. There is no REIT that doesn't have debt. They all have a lot of debt. They rely on debt. So maybe start with that. Like, why is it so hard to just simply say, hey, we can hang out, we can hide out here, we can hide out there?
Yeah, thanks for asking. That is really the $1 million question. I think I want to kind of bring back a couple of concepts from our prior conversations about, as a more liquid proxy of real estate, REITs have historically led declines and led rebounds, whereas the private market tends to, mark to market much less, have less transactions, and there isn't a benchmark, there isn't a universal compare. That being said, there's what the properties are doing, there's what the companies are doing, and then there's what the macro environment is doing. And frankly, because of the setup, because of this, a lot of the distress, even around interest rates, sorry to spoil the party, but I don't think there is reprieve. There isn't a place to hide out. Now, there's when I say this is, I think I have to preface it by saying that a retail investor doesn't have to invest in REITs.
Right.
A retail investor can be long, can be short, can invest in treasuries, what have you. There's no mandate. We talked to friends of this show, and one of the most insightful things I ever learned was the idea is don't compete against yourself. Don't put yourself in a wall where you're all in, where you have to be right. That's not what you get paid for. But for a REIT only manager, a long only benchmark aware or benchmark focused manager, the question of capital allocation is sometimes a much simpler one, right? Because there is a lot of index focus, there is construction, there is, when they are managing risk vis-a-vis the benchmark and the different factor exposures that could lead them to outperform or underperform on any given quarter, frankly. That's the dirty secret. When you're in an institutional seat and your gatekeepers are the consultants who have quarterly, return comparisons and rolling 1 year and 3-year compares to look good for some fact sheet, that's the dirty secret in the game. Even if you have a great year, show me what's new now, right? There's kind of you have to prove yourself every year, every quarter. So when you have these periods where things look like they might hit the wall, it's a lot easier to say, hey, I'm long large caps, I'm long S&P, I'm long quality, what have you. I'm going to pick my litter of certain sectors that I'm starting, maybe it's top down, maybe you're overweight residential, multifamily because of certain thematic sectors. You're going to say, hey, prove me wrong, office, prove me wrong, retail, right? And then you have these big rips, the short squeeze, SL Green, BC,
SL Green, yeah.
Right, because all the managers are caught off sides. Everyone is naked versus the benchmark. And now, granted, these companies used to be 2-3% of the index, and now they're only 1% of the index, right? Even their relevance has come down, but when that part of the benchmark squeezes, you can imagine there were a lot of underperforming managers this month, very likely. But again, going back to the biggest question at hand is, because leverage is a feature, not a bug in real estate at large. The public real estate companies are actually some of the least levered real estate platforms out there compared to family offices.
That's fascinating.
Private equity leverage. So, there's going to be there may come a time where there's no bid, right? And how do you plan for that? That's not it's not good risk management to hope for to worry about the worst and not to get in. But we've seen in history and in prior cycles, real estate is one of those tricky asset classes where, because of the nature of the financing of the asset, which is typically with longer term debt, for the higher property, the higher quality the property, usually the higher quality the tenant, the higher quality the cash flow stream, and because of the way that real estate is marked and transacted, the more likely you're going to see some correlation with risk-free rates at the longer end of the curve. Right, which it's like being able to buy a house. You're using a 30-year mortgage, a 15-year mortgage, and your ability to make monthly payments and at the margin, the incremental demand from the buyer and their ability to pay more is going to be determined by cost of debt. Now, you do have all buyers, just like you do in institutional real estate. But again, the feature of leverage is so cost of capital dependent. Now we're in a situation where the yield curve's been inverted. And Jerome has flat out said, hey, maybe I'm going to go 2 more times. How's that? How do you like them apples, right?
How do you like that?
So in some ways, we've seen the long end of the bond curve hold under 4%, which I've actually been surprised by, but it's actually tuning in there. And then we said last time, what happens when they raise or hike rates 50 more basis points? Even if the 10-year doesn't move, even if the long bond doesn't move, the incremental demand or the impetus to invest in any risk asset when short-term risk-free rates go from 5 to 5.25 to 5.5 to 5.75, right? What's the hurry? What's the hurry? And that's a hard objection to deflect. And that might drive near-term pricing, near-term demand, near-term sentiment. It doesn't mean the assets are impaired, right? It doesn't mean that the winners are not going to win. It doesn't mean those assets that are secularly impaired are not going to go away, even if they bounce on any given day, any given week. But all of this raises more questions. And we do know that when there's uncertainty in cost of capital and there's uncertainty in macroeconomic conditions, the risk-free rate goes higher, the discount rate goes higher. And the mental bid for any equity, especially real estate, goes lower.
Right. No, I love that. And so, so this graph here, we've been here on this for a minute, is the difference between public and private REITs. Basically, they're looking at a private REIT index, but in a lot of ways, you could take that for a proxy, right, for private real estate in general, whether it's held in a private fund or by mom and pop or whatever. And the point is, and basically, so it's almost like an inverted yield curve, right? Like the inverted yield curve, the yield curve inverted before 2000, it inverted before 2008, and it inverted before 2020. And that's, and then obviously it's like 6 for the last 7 or whatever it is, predicting recession. So that's why there's such a focus on the inverted yield curve. You could almost say REITs relative to private markets, there's almost this inverted yield curve-ness of it, where it tends to be predictive of future pain, but maybe not prescriptive in that you can't just, okay, well in the next 9 months, maybe not prescriptive in that it tells you which tactics to take of how to necessarily make money in markets, but it's just a warning sign of, kind of be careful, right?
To the layman, even to just a set of eyes looking at this chart, there's never really been a period of sustained premium to NAV valuations or sustained cost of capital pricing for the public market, and the private market has not corrected, right? In both
Yeah.
the dot-com era and the great financial,
Yeah.
crisis. We had to see really liquidations, distressed sales in the private market to create that vicious cycle feedback loop
Yeah.
that creates a FUD, and then for the market to come out of that FUD. Right
Yeah.
now, we're still anticipating the FUD, right? It's not even
Right.
here yet. We
Right.
hear about gatekeeping, and so I'm not going to say there doesn't have to be anything, but if
Right.
history is any guide, and for this sector and this asset class, which is a lot more history than not, some things have to come to pass before the incremental investor can say with any type of credibility that the worst is behind us, because we kind of see what the worst case scenario could be in a few of these asset classes, sub asset classes within real estate, where
Yeah.
demand is off the cliff and they haven't been able to come back. But as far as just the interest rate volatility and the broader economic malaise, we have to see some of those things come to pass. It's still my professional opinion before we can feel better about the sector at large.
Yeah, no, that makes a ton of sense. And you've been very consistent on that. And I've been trying to get you to say otherwise. I've been trying to get you to say, buy REITs with both hands. I, Jimmy, support this. And I just can't get you to say it. So we'll get it out of you eventually. But you definitely haven't. You've been very consistent. So this is, I think that makes a lot of sense. And to tie it into the Eric Basmagian, you notice most of these shows, I kind of say the same things, but Eric Basmagian says real estate is the economy. And maybe that and the fact that the average homeowner had, a large amount of home price appreciation during COVID, that's part of what kept the economy potentially intact. That's a working thesis, at least.
Yeah.
And to your point, like real estate is this lagging indicator, and it's but so this is fascinating, right? ITB versus XLRE. I mean, I don't know what you do with this information. I don't know which trade. I think trade's pretty extended now, if that was the pair trade you're looking for. But there's something going on in REITs, these are in interest rates or fundamentally or whatever that's driving this, because this would be hard to consider just random movement, right? This is an absolute breakout here. So
the market,
yeah,
I'll kind of give you my take on this, right?
Please.
I've been, I think, notably wrong. I've shorted home builders, and
Okay,
all the way up here. I think
you listen to Hemowitz, man. That guy was money.
At a high level, home builders have a small recurring profit stream, but most of their business, as you can imagine, is one time in nature. It's transactional. They are developing, selling at a certain margin. They are consistently replenishing their inventory so they can maintain their pace of sales over time. Depending on where we are in the economic cycle, companies can strategically prune their pipeline or to build out their pipeline at prices they deem opportunistic. But from the investor side, home builders and even single family home rentals, there's been a lot of, this ties a little bit back into BSM. There's a lot of different proxies, and sometimes people are expressing a certain viewpoint using these vehicles. And it doesn't reflect fundamental optimism. It doesn't reflect, people willing to pay a higher multiple for what is typically a one-time transaction. What I will say is that, what is not surprising is that home supply remains at all-time lows. We know that people are trapped in their homes. They're trapped in their homes with a healthy amount of equity, right? Because they refied at zero and the home prices shot up and doubled in some cases. And I'm continually, I remain surprised by how many clients and prospects I talk to where there is a mentality now where people have seen their parents and their prior generations, use reverse mortgages, or think about building up, the accumulated equity value in the home as something that continues to go up, and then being able to draw from a line of credit to fund their lifestyle.
Yep.
It's such a given now,
Yeah.
housing goes up is such a given.
Yep.
But again, because what's tricky is, we've seen no real distressed sales for prices that are clearing in the market in neighborhoods that are desired. We've seen very, very resilient housing prices. We've or pretty, meaningful, declines over the next several years, right? There's just not a lot of place for underwriting optimism, and that translates into, equity weakness. We're back. We're talking about home builders. We mentioned, how resilient home prices and home price appreciation in some markets still have created this scenario where investors, speculators, short-term, long-term, are voting with their dollars. So that's why multifamily's done well. That's why single family's done well. That's why home builders have done well. Certainly better than office. Certainly better than some of these other more thematically challenged sectors. Whether that's warranted or not, we'll find out. But costs are down, margins are higher, and I don't even think investors are thinking whether these companies can replenish 25% of their inventory, 30% of their inventory, right? To earn this multiple that's certainly elevated. So if earnings are going up, what's the quality and sustainability of that earnings? I don't think the market cares today.
Yeah, no, 100%. What interesting standpoint on the home builders, or one really interesting point that was pointed out to me, somebody else made on Twitter. I just thought it was really interesting. Is thinking through when you think about the existing housing market, the home builders only represent new supply. So that's one proponent of the housing market, but then you have, or one component, but then you have the larger component is existing supply. And so the, you could have a situation where the existing supply doesn't turn over much or starts to have real issues. And this new supply, when you hear these guys talk about the structural the under housing, or the demand for housing from millennials and such, there's that component.
Yeah, I mean, it's a good story to tell, right? If you're the CEO of or any other home builder, the new supply doesn't really compete with existing supply on price today, because for a variety of reasons, existing homeowners are locked in. They have low interest rates, they have lots of equity, they don't want to move and surrender that, below market debt, which is almost an asset for them. But typically newer builds are higher quality, they cater to a different customer that's more affluent. And when we think about pockets of supply in places that are still desirable, a lot of the times those buyers are moving out of even higher cost, bi-coastal living areas. So they're making a lifestyle choice. Again, I think where we've seen coordinated distress is when there's been capital markets distress. When there's capital markets distress and there's fundamental distress for the consumer, existing homes start getting cleared at liquidation prices or at short sale type prices, and then that can affect the velocity of new inventory clearing the market. But right now, I think the prevailing consensus is that existing supply is so tight, so limited, that the incremental family unit, right? The millennial that's aging, that has children, that's looking to buy a home, whether it's a first-time home or a second home, that segment of the market, just the supply and demand factors are much more favorable for these home builders.
Right. So no, that makes sense. Are you good maybe till hard stop 12:30?
Yeah, let's go to like 12:30. How about that?
Perfect. What about the idea of, and I can even cut this out, doesn't matter, but what about the idea of let's slaughter these 5 sacred cows, 5 minutes each and get out of here? Like, what do you want to go through that? Let's go through those names. Cool. No, that's great. So, there's different ways of thinking about safety, or you know, thinking about this concept of a big boat to get you to the other side. You could look at business model, balance sheet, management team, you know, a combination thereof. You could look at quantitative factors, right? Like we publish this daily. Part of the reason we do this show is to bring attention to our daily email. If you're interested in real estate investment trusts, excuse me, going the wrong way, and you want to, you know, trade them up and down, you want to buy and sell them, and you want to maybe trade them against each other, here's a good resource for you, and it's free right now. Go to www.swamiresearch.com and click on the looking for the download, I think is what it is, and that will get you the daily ETF report, which has these REIT scores in them as well, which over time Jimmy and I are going to provide, especially Jimmy, more thoughts and more context on these scores and on these tickers. So one way you could look at it is like, and this is probably for me base case, right? So the first thing I would do is I was looking to be long REITs. I'd want to be long REITs with high Swami scores. My bias, of course, but you know, the Swami scoring system is a good way to avoid, you know, drawdowns essentially. So step one, avoid low Swami scores. Step two, avoid declining Swami scores. And step three, yeah, just buy. If you can find high scores that are staying up there, that's what you want to own, especially on dips. So that's the shameless plug. But within, so let's, you know, we've got five sectors within REITs that we look at. Consumer REITs, we're piling a bunch of stuff in there. You know, you even got a wheat REIT tied in with, you know, some hotels and some retail properties. You've got healthcare, you've got housing, industrial, office. Obviously, some business models are more challenged than others, right? Post-COVID, especially, office is especially challenged. So, blah blah blah. There's a lot there, but I gave Jimmy 5 candidates of names that we've talked about sacred cows earlier. Maybe REIT sacred cows, or REIT people that REITs people can consider conservative and have strong balance sheets. Some of their, like, for example, let's start with Realty Income, right? Maybe the ultimate, a lot of Seeking Alpha guys write it up as the ultimate swan REIT, sleep well at night, right? It's got 30 years of raising the dividend. It's paying about a 5% dividend here. And they're in these kind of consumer non-cyclical businesses. Like they have a lot of Starbucks, Walmarts, grocery stores, CVS, Walgreens. So anyway, so idea one, or the first sacred cow to look at here, is something like, oh, I mean, should I be, you know, this is to lay out the case one step further, and I'll be quiet. Let's look at O, and let's look at the dividend of O, because I think it's an interesting place to start. So this is Koyfin, for those not familiar. I think this is just an interesting thing to look at here. So what you can see, the first thing you see when you're looking at the dividend for Realty Income, come on, baby, is that it goes up. That's what I'm trying to show you here. It's gone up for 30 years in a row. That's the point. And in fact, when you can get it at a 5%, you haven't been able to get it at a 5.2% yield since back in about 2017. And so the idea is, if you can get Realty Income at a good yield, it's a conservative business. You know, is that an interesting place to wait out the end of this REIT storm? Essentially, just a closing sentence here. You know, REITs in general, we've been in a decline. We've had, you know, we've we're a long way down, right? And we've been in a decline for a year and a half now.
We have. Before I get to kind of my opinion on Realty Income, are you able to see what their FFO payout ratio is? I know
Ooh.
you checked out their dividend yield when you go back to Realty Income. Any more information on you know, FFO, AFFO,
Let's
what
look in
their
the presentation. That probably is the
yeah,
best.
you can even look in the presentation, from February this year, they have maybe a rough sense of guidance.
Yeah.
Uh, you look in here, aristocrats, keep going. Um, keep going. They'll probably be buried under the financials, right? So here,
Yeah.
just
More.
um, and really, this is my thinking. On an
Yeah.
absolute basis, the dividend yield hasn't been this high in exactly the time frame that you've talked about. This
Right.
is a company that has historically been a very astute capital allocator. They don't overpay for empty boxes, for the in-place lease. They have a
Yeah.
very recapture ratio. So that just means that by the time that the leases actually expire, they're actually able to extract more rent over a 30-year period. And now when you think about the way that triple net leases are often structured, there are CPI bumps. So unless a shopping center, unless a piece of real estate has actually appreciated meaningfully over the lease term, you can get into a situation where at the end of the lease, the tenant might be 20% above market
Right.
compared to the lease. And so there are these nasty income step downs. But then you might have another, there's something called cash to cash and also the gap spread. So the gap spread analyzes the average yield for the duration of the lease, whereas the cash spread more reflects the last year's lease number versus what that new first year cash rent looks like. So what happens often is like you have these curves that go up, 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 up with all the lease writers,
Yeah.
but then they get reset to a lower base, and then there's a new up, 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 right?
Okay.
So, firstly, I'll say that excuse my French, but the 5.17 dividend yield isn't shit. What is the risk-free rate over a 3-month period, over a
That's right.
6-month period, over
Yeah.
period? And this is below the risk-free treasury rate. It's below CD rates, right? So you're not going to find, if I'm looking for income with preservation of principal, it's hard to make a case for Realty Income or frankly for any REIT
Right.
when comparing some of the traditional, competitors for capital, right? For dividend capital, competitors for value add capital. We're not even talking value add. So this is a steady company. I think that if I am a long only manager, I certainly want to be market weight this company
Yeah.
just based on factors that are favorable. And there are times where if there is a cost of capital or credit crisis, this company tends to outperform. But like we said before, if the Fed goes from 5 to 5.5, that increases the discount rate for all of corporate America. And I don't know how investing in this company, which typically doesn't add a lot of value, the value is created and solidified by the accretive nature of the financing done
Right.
at acquisition, right? It relies on a premium cost of capital, buying higher cap rate assets on a one-off basis, and creating financial value on day one. Now, there's residual operational considerations, but typically as a percentage of the value add in the deal and how assets get acquired into Realty Income, for something that is not actively managed in that sense. There's not a lot of, for me at least, it's not worth a squeeze to deploy here versus in a CD.
No, I hear you. So basically what I heard you say, Jimmy, is it's not necessarily it's not sleep well at night, maybe for certain risks, right? Like deflationary shock for sure, but it's not a sleep well at night REIT if we're considering like a higher for longer scenario. Would you say that's fair?
I think that's very fair.
Yeah.
It's the person deploying capital today has seen the market rebound, based on a prior discussion in almost an incredulous way. right? We've seen the narrow breadth. We've seen the concentration of outperformance in certain names and certain thematics. You know, I still have to think there is more so than the, hey, what happens to the world 3 years from now? I think most people are still trying to get past these next 12 months.
Yeah, yeah. No, very well said. So our first sacred cow, I wouldn't say you slaughtered it, but you definitely pointed to some gaps in the logic of just, yeah, buy it now. And I mean, because I guess the concept is, yeah, these guys are the big boat. If we get, as this back to our Janus chart here, as private real estate values come into line with public real estate values, Realty Income can take advantage of disconnections in the market, and maybe that's the bull case potentially. But but that's just one version of the future. And a strong bear case is just, look, if rates don't come down, why would people be piling money into these kind of retail properties at 5% when you can keep the money in your bank account at 5% or a little bit better?
That's exactly it. And so when I think about the acquisition environment, in the private market where rates are going up, for assets that have always traded at high single digit cap rates and even double digit in some cases, if unless there's material distress where my hand is being forced, there's not a lot of private market interest.
Right.
There's not a lot of convenience store owners that are looking to cash out of their real estate to grow their business.
Right.
Because when you do a 1035 exchange and you're providing capital to an operator, what is the end goal for every mom and pop operator that got into a franchise 40 years ago that has seen tremendous capital appreciation in the real estate? I mean, at some point, they're not just taking the money to retire. For the deals that a lot of these players look at, they're buying out private platforms, and the private platforms, unless they're returning capital to their investors, they're looking to grow. So you need a lot of things to happen for the markets to become liquid and for the 1035 market to really work. And when you have a large company like Realty Income, they can't move the needle on a few $1 million acquisitions. They can't even move the needle on 100 million.
Right.
They would argue you can't even move the market on $500 million. You're talking about billion plus yearly acquisition volumes with healthy funds, and that requires a lot of healthy other things.
Yeah. No, very well said. So that's one candidate number one. Let's look at here, and then two more kind of categories, more on the business model side. Although these guys, well, I'll tell you don't you think about these? So the government tenant REITs, right? So these guys are pretty levered, but their tenants are government agencies and various government departments. So we'll look at those. That would be like DEA and OFC, Corporate Office Trust. And then we can also look at the apartment REITs. And that would be specifically the two I'll show you today that are known for being more conservative on the balance sheet side is EQR and AVB, and they're high quality properties and they're high quality balance sheets. So maybe those as places to park capital. Maybe let's start with the government tenant guys. What do you think? Can I sleep well at night plowing capital into these government tenant property REITs, or what do you think?
So I think from a price performance standpoint,
Start there. You're right.
Yeah, you could take a look, and I would love to see you even compare OFC versus BXP, right? We can do this kind of contrast where you're talking government tenants that are more bond plus proxies historically, versus some more kind of enterprising corporate tenants. And that chart explains it. The story has been that we've had a meaningful rotation since yield spiked last spring, right? That April to June 2Q bloodbath timeframe. We've seen people rotate out of the private market as far as office tenants are concerned and seek the safety and credit quality and maybe the more lower beta defensiveness of corporate office, of DEA. Now, the bulls say, hey, you have high quality leases at a time where credit matters. You would rather take on credit risk and be in a good credit portfolio than take on tenant risk and take on more pro-cyclical considerations.
Right.
But again, that's I would say that is pretty consensus.
Yeah.
In my time viewing these companies, there are times where when the market is more pro-cyclical, more focused on who's adding value during the cycle, these companies sometimes get relegated. If they're not crispy clean and trading at risk-free rates, they're trading at higher cap rates as suburban office companies, right? Because what we talked about credit enhancement at the beginning of the show before we started recording with regards to master leases and how having 1,000 properties or 100 properties lumped together and underwriting the aggregate cash flow is better than underwriting a specific property, where there's less volatility than underwriting a specific property. Now, if you have a DEA, an ATB, another federal office in Tulsa, Oklahoma, in a market where suburban offices, CBD offices have no business trading at 5 caps, 20 times multiples, you can artificially create value by bringing in a strong tenant. If you bring in Amazon, if you bring in Walmart, right, the market's going to price that accordingly. Right. And historically, when landlords have been able to secure government tenants with sizable lease lengths, they've been able to enhance the value of the cash flow stream. One might argue that, are you actually adding value to the building? I don't know, but the building's going to trade at a different multiple. So there's been a lot of value over the years, but then also when there are times where the fundamental risks are assessed, these companies don't shine as bright. So when a tenant has only a few years left and they're saying, hey, we might, not renew our lease, guess what? These buildings lose half their value, right? So it's a tricky game. I'd say from an incremental allocation standpoint, it's more likely that these names have already priced in their relative outperformance vis-a-vis BXP, SL Green, and some of the more traditional office tenants. Yeah. But that doesn't mean that as we go into the mouth of the cave or to the belly of the beast, whatever transpires over the next 12 months, I can bet they're likely to dip less, but also recover less, right? So if you're catching the V, you put a gun to my head and say which company has a better performance over the 3 years. I'm probably taking BXP and SL Green over these guys.
Right.
Yeah, we have to survive the next 12 months first.
Yeah, very well said. And look at this payout chart going back to 2000. It doesn't look natural, right? It's interesting how it's very blocky. I mean, I don't know, I'll say that. We'll look at O in just a second, maybe get a better look. But and then you had a big cut post GFC. So it looks like 2011 or so, you had a big dividend cut.
And corporate office properties, for just a little history.
Yeah, please.
Historically owned a lot of suburban office assets in the greater Washington area, Baltimore, Maryland corridor. Yeah. And so when you look at dividend payments, really even a couple of years post GFC, this was an asset class that was very much out of favor. Suburban office had a lot of existential risks. So they were collecting, they basically had to cut their dividend. And you see, as they've pivoted to more data center and to other complementary asset classes, their focus became less of a levered REIT, which they definitely were pre-GFC. Yeah. Less of a levered income REIT, and more of they're trying to become a little bit more total return. Now they still have a lot of, less than stellar properties with good credits, good tenants, But as far as where they're trying to use their incremental cash flow, they're going to either expand into data centers or, acquire properties that are slightly higher quality. So
Right.
as you high grade your portfolio, you're taking on dilution, right? Because the
Right.
incoming yields are lower than your in-place yields, and their hope is that the market rewards them with a lower ascribed cap rate to reflect the increased portfolio quality.
Totally. No, it makes sense. And if you look at O's, that looks like a more natural. I don't. It's just a more, well, it's for sure a more increasing, and it's definitely the dividend stream you'd rather be long, probably. Let's look at these. Let's wrap on some apartments. So the apartments are really interesting to me. Back to the Janus chart one more time. It's like, man, you look at something, you look at an EQR or an AVB, and you can come in and get a 4% dividend yield. Let's look at that historical dividend of EQR. You can so I think the dividend is interesting. You can see that it's historically pretty high, right? Let's look at kind of a historical yield. You can look at you haven't been able to get a 4% dividend on EQR since the GFC, right? Or except for maybe for a couple of weeks during COVID. It's a bunch of Class A properties. They're gateway cities. You did have some you had some Sunbelt migration maybe during COVID that maybe you have that as like an easier comp, right? Like you had people move from LA and SF and these places where EQR is more concentrated and AVB is more concentrated. So that's almost a tailwind. But the last thing is, and this is really, simpleton versus true black belt here. Tell me where I'm, not really kidding. But tell me one way of looking at it is like, look, you put money into EQR right now, you're getting a 4% increasing dividend, which the track record is very good. I don't think that data is totally, there's some weirdness in that data. The track record is very is great.
There's a special dividend in the middle of the last decade. You see that, right? So
that's what it is. Got it.
Yeah.
So it throws off. Yeah. Go ahead. Sorry. Well,
no, it's okay.
Yeah. But really where I'm going is like, look, if you look at this property here, and it's like, or at these properties, and it's like, if you went out and bought this building here, or I don't know, one of these other buildings they own, you went out and bought that, you buy these properties. If you went out and bought, if you had $200 million in your bank, you said, okay, I'm going to go spend $40 million. I'm going to go buy an apartment complex. Are you getting, and it's in Los Angeles, in a desirable, Manhattan Beach neighborhood, are you getting a 4% cap rate? I'm not sure that you are, right? So it's like, why would you go do that at a 2.5% cap rate or whatever these guys are underwriting these Class A buildings at? If you could just buy a stock and collect a dividend, I'm missing some things. It's not a true apples to apples comparison, but what do you think about that as kind of a jumping off point as to why the apartment REITs are starting to at least get kind of interesting?
It's hard to not take a look at the historical context. You mentioned that with Realty Income. You mentioned that with EQR, and again, on absolute terms, there is an increasing margin of safety. People are willing to wait and collect 4%. And everything right now is, unfortunately or fortunately, within the context of the greater Fed policies that are distorting, transaction market and capital markets. The best assets don't trade. The best assets are highly coveted. The best assets are liquid. And unfortunately, the difference between a 4 cap and a 6% and a 6 cap is 50%. And so there is no, I would say virtually no, private or public market operator if you have a crown jewel where it's $100 million building, you've got high, price per unit valuations, they're cash flowing. Why would you sell at a 6 here?
Right.
And also, why would the buyer buy at a 4 or even a 5 today? So everything comes back to the starting point, which is the risk-free rate. And if you're about to deploy $100 million, really the only places you can really go in real estate are multifamily and office.
Yeah.
And one would say that, that was pre-COVID office, and that office prices have come down significantly. So for the institutional capital deployer, whether it was a pension fund, a private equity firm, multifamily is still one of the only games in town where you can actually raise capital and deploy it and earn fees on your deployment.
Right.
So I expect the demand to be evergreen, but I expect right now the markets to not be very liquid, and at a minimum, I think we were talking about implied cap rates earlier as a proxy for where the market is valuing the price of the equity, right? It's like based on the price of the stock today, where is the market valuing the equity in the company, aka where is the price relative to a supposed NAV?
Yeah.
And if risk-free rates go up to 5.5%, it's hard to make the argument, why, in the absence of a new business cycle starting and any semblance of cap rate compression, people have talked about, hey, we've actually seen cap rate compression in multifamily. Some of that is based on public prices going higher. Some of that is based on specific transactions, that maybe it traded at a 4.5, but it probably would have traded at a 3.5 last year, based on lower cost of capital, and presumably there's been some income growth. So that 4.5 is more stabilized today. Whereas the 3.5, people are trying to get some upside on that asset, and that's why it was a lower cap rate. But nevertheless, just going across the real estate sector, the interest rate sensitivity, it almost sounds too, easy or too silly, but I'm probably shorting any company whose implied cap rate is beneath the risk-free rate, saying, hey, for the next 12 months, I could collect risk-free from the government, or I can invest in your company at today's stock price.
Right. Well said. Well said. No, I think that's probably a great place to end it. I mean, I think that there is, as this chart really probably puts it better than I ever could. It's like, all this tells you is that, like the inverted yield curve, there's a shakeout most likely to come. And, that's part of what's so interesting about these publicly traded REITs. They trade every day, and we can collect, we can get price data on it every single day. And yeah, it's going to be interesting to see these lines, reconnect, whether it's the bottom one coming up or the top one going down, whatever it is.
You got me all teary-eyed and shit. But no, it's true that there is season 2 of The Bear is out.
Yeah.
And a good show. There's a line where Jeremy Allen White is saying, hey, he's waiting for the other shoe.
Yeah.
And his girlfriend at the time says, you want to hear the secret? No one's counting shoes. No one's counting shoes, right? We're going to take a lot of L's, but there are shoes to drop. And unfortunately, in life, we take a lot of L's. But in the capital markets, where you don't have to take an L if you don't deploy capital, people are waiting for the shoe to drop. and it's coming. We don't know how big the shoe, we don't know where it's coming from. But things were breaking with the long bond above 4%.
Yeah.
Regional banks, collateral, all that stuff. And like I said, we got to buckle up, put on our big boy pants, and then this second half is going to be interesting. But really, the next 12 months is going to be, will kind of determine I think, when we think about, are we going to have more of a multi-year drawn out repricing a la the dot-com era, or are we having more of a V-shaped trajectory? The market return will say that, we've been so used to buying the dip that there's a reflexivity and that we want this V-shaped price recovery, market recovery to happen. But we've piled on one thing after another. So we got student loan repayments coming back. We've got higher interest rates starting to flow through the real economy. There's a lot of things, right? We're seeing job losses and layoffs in different sectors. All the leading indicators globally, remain in contractionary mode, with the exception of China. There's some acceleration there, but really, when we look at developed markets, Europe, North America, when you listen to the state of the consumer, Nike on their annual,
Yeah.
earnings release, continuing to be cautious because I think they see what we see. This is a very, very stretched consumer. This is a bifurcated, it's been a K-shaped recovery since 2020.
Right.
And maybe there's more room, but
Yeah.
for both the cohort that has nothing, that is struggling, and the cohort who saw asset prices go up, their home prices go up, people are tapping into that now. And that margin of safety is gone. So we're going to have some difficult choices to make, I believe.
Man, I just messed this chart up, but yeah, that's great place to end it. I mean, I think that's very well said. As you were talking about no, I mean, that's a great point. And, really, I really enjoyed picking your brain on the specifics, this portion of the market just so well, this corner. And I think it's a really interesting corner to watch, for a variety of reasons. And it's funny how, like you said, it wasn't long ago. It was what was it, September, October, that's when USD JPY hit 145, the 10-year hit 4.25 or whatever, and things started breaking. And then, kind of like Trump said about the virus, just you're in the middle of the night, it's just gonna go away. And the MOF intervened or whatever, and US JPY went back down, and everything just kind of went away. And Tesla's to 260. I mean, I wouldn't have believed you if you told me this is how it played out.
No, I mean, when is the intervention coming next, right? You see that, you see the cross currents in the currency market, and how we're back at some critical levels.
Yeah, right at 140. They intervened twice. Their first intervention was at 145. I think the next one was at 150. We were at 145 yesterday. We're right back there. Like you said, yeah, I don't know. It's a lot of moving parts, but the whole concept here was, we don't, I see, there's the whole concept here is like, maybe if you this is a hard game we're playing, but maybe if you use price signals like the ones Joe Catanzaro developed that we are turning into the Swami score, and you combine that with a dude who worked on Wall Street and covered REITs, maybe if you use both of those together, you cannot lose your ass, but not yet. Because it looks like it's still ass losing season out there. So that's what we're working on. We'll keep coming back, and we'll give you guys more. And Jimmy, really appreciate your time, and thanks for
always
watching Real Assets Weekly. Cool, guys. Have a great week.
Take care, guys.